Chapter 1. Make sure you understand the basics before you even try to invest. Stock can be defined as a form of security or proof of ownership. It is used to signify that an individual is entitled to the assets and earnings of a company. There are two major types of stock. Common stock. This type of stock allows the owner to vote at shareholders' meetings and receive dividends issued by the company. Preferred stock. This stock does not confer voting rights but includes other rights not found in common stock. Preferred stockholders can, for example, receive dividends before common stockholders if the corporation goes bankrupt. Without assessing information carefully, you could easily overlook minor problems and lose money. Before investing in stock, you need to assess relevant information regarding the company you want to invest in. Elevate the industry and the general economy in which the company exists before and after buying stock in a company. Successful stock picking isn't mysterious, but it does take some time, effort, and analysis. And the effort is worthwhile because stocks are a convenient and important part of most investors' portfolios. Paul Mladenovic. Information gathering is critical to the success of your investing pursuits. If you don't do your research, you could pour valuable money into a poor investment. To work out the actual value of a company and its stock, you need to assess its market value or market capitalization. This information is essential for successful investing. In the following sections of this summary, you learn all the important things you need to know about stock trading. You will discover some time-tested strategies for creating and managing your investment portfolio. Chapter 2. Market capitalization is an important measure of a company's potential. To calculate the market cap of a company, multiply the share price of a company's stock by the outstanding shares owned by the company. These are the basic categories of the stock market. Microcap, less than $250 million. The least risky you will find because they're the smallest. Small cap, $250 million to $1 billion. Fare better than the microcaps and still have plenty of growth potential. Mid cap, $1 billion to $10 billion. Offers a good compromise between small and large caps. Large cap, $10 billion to $50 billion. Best for conservative stock investors, often called blue chips. Ultra cap, more than $50 billion, also known as mega caps, includes Apple and Google. Knowledge is your greatest asset in stock investing. Second is your common sense. To be a successful investor, consider these critical factors. Know the reasons why you want to invest in stocks. Are you seeking capital gains or income? Do some research on the company to see whether it's a profitable business worthy of your dollars. Consider buying in smaller quantities. You can buy stock for as low as $50 using special programs like dividend reinvestment plans. Do as others do, not what they do. Look at the company insiders before you buy or sell a particular stock. Market capitalization is an essential factor to consider when deciding to invest or not, but it is only one measure of value. As a serious investor, look at many other important factors that help to determine the viability of a given stock. Did you know? Volatility is a condition in which there is a rapid movement in the price of a particular stock, a sudden drop in price in a relative short period. Chapter 3. Prepare and review your balance sheet to find out how much money you can invest. Your balance sheet will help you maintain balance in your financial life. Investment is a calculated risk, but it is still a risk. Hence, always invest only the money you can afford to lose if things do not work out. At the same time, you must invest enough money to ensure that you make significant profits if the stock rises. A disciplined investor also has investment-grade bonds, cash in bank accounts, precious metals, and other growth assets. Stocks are just part of their investment. In all investments, diversification is the key to minimizing risk. Creating a balance sheet is the first step you must take to make it as a stock investor. It displays your assets and liabilities at a single glance. It will paint a clear picture of how much you've won and how much you owe. You can use this to help you make healthy investment decisions. Composing your balance sheet is simple. Put together all your financial documents. It would be best if you had figures from these documents and then followed these steps. Step 1. Keep an emergency fund. First, list cash on your balance sheet. The goal should be to have in cash or equivalent a reserve of at least 3 to 6 months of your gross living expenses. The cash is significant because it gives you a cushion. Don't think of your investment in stocks as a savings account generating more than 20% per year. It is dangerous thinking. Step 2. Listing your assets in order of liquidity on your balance sheet gives you an immediate picture of which you can quickly convert to cash and which ones you can't. Step 3. List your liabilities. These are bills that you're obligated to pay. Never avoid listing your liabilities because you're embarrassed to see you owe. Step 4. Calculate your net worth. Your net worth shows your total wealth. Use this basic equation to calculate your net worth. Total assets minus total liabilities equals net worth. Net assets or net equity. Step 5. Analyze your balance sheet. To understand the state of your current finances, take a close look at your balance sheet and try to identify any changes you can make to increase your wealth. Avoid excessive debt. If you don't, you will end up selling your stocks to remain liquid. Chapter 4. Look for information in accounting and economics to learn a substantial amount about companies and their finances. To understand a company's finances, you might have to take up classes in accounting and economics. It will be time-consuming but worth it in the long run. Take what you own and subtract what you owe to get your net worth. There are the 3 essential principles to accounting. The difference between your assets and your liabilities is your net worth. A company's net worth indicates the solvency of a company, its ability to pay off debts and remain in business. The difference between the income and expense of a company is the net income. The potential profitability of a company is the primary force that drives people to invest in a stock. To understand the profitability potential of a company, assess how it employs its financial increase. To get the whole picture, always compare the performance of one company with another. Say Company A makes a net income of $50,000 at the end of a working year. That will seem like a unique investment option because the fact that a company makes a profit is the first sign that it is the right investment choice. However, you will want to assess the net profit further. Compare its performance for 1 year with that of the previous year, and if possible, with the performance of a different company from the same industry. This will help you understand the performance of the company's profit better. What should you do? Become an investor with a time horizon greater than 1 year. The emphasis is on greater. Give your investments time to grow. Paul Mlejanovic. There's a lot of financial news on numerous companies flooding into the ears of investors daily. To make sense of this information, you must understand one significant financial concept. Supply and demand. Supply and demand is an ageless concept. It describes the relationship between the availability of goods and services and the desire of people to purchase these goods and services. The relationship between supply and demand is the engine that runs all economic activity. Understanding this relationship will aid your stock investment decision making. Chapter 5. Find a high-quality broker to buy the stock once you decide to invest. A broker is a vital piece of your investment puzzle. Numerous companies operate as brokers. They include Charles Schwab, TD Ameritrade, E-Trade, etc. Take your time choosing your broker. A wrong choice could lead to lost money and a poor investment. There is a difference between stockbrokers and institutional stockbrokers. The latter deal with companies and institutions, while personal stockbrokers deal with small businesses and individuals. For security, ensure that any broker you deal with is registered with the Financial Industry Regulatory Authority, FINRA, and the Securities and Exchange Commission's, SEC. Stockbrokers fall into 2 basic categories. Full-service brokers. These are for investors who need guidance and personal attention. Discount brokers. These are for investors who are sufficiently confident and knowledgeable about stock investing and managing with minimal help, usually through the broker's website. You can check the integrity of your broker by obtaining a free report from FINRA through the website www.finra.org or call them directly at 800-289-9999. Analyze your investing style to choose the kind of broker that suits your needs. Keep the following points in mind when it's time to select a broker. Choose a brokerage firm that charges the least amount of money for the services you will use most frequently. Compare all the costs of selling, buying, and holding stock and other securities through a broker. Don't compare commissions only. Compare other factors like interest, margin, and additional service charges. Use broker comparison services. You can find these in financial publications and online sources, such as Kiplinger's Personal Finance. Chapter 6. The top 5 indicators of an excellent stock will steer you in the right direction. It's likely to be borderline impossible to find a stock with all 5 hallmarks described in this chapter. Yet, if you can find one with even half, it's a super solid choice. Number 1, the company has rising profits. The core of a successful company is its ability to make a profit. Profit is the most critical financial element of a company. If a company isn't making profits, it's going to fail pretty quickly. Making ends meet isn't enough for a business to thrive and be successful. Number 2, the company has rising sales. Looking at the total sales of a company is referred to as analyzing the top-line numbers. An analyst can do many things with the numbers on an income statement. Number 3, the company has low liabilities. Debt can be all-consuming for a business. When a company has low debt, it has the power to borrow. That also means it can look towards takeovers, helping to increase profit growth now and in the future. Number 4, the stock is at a bargain price. Price and value are very different concepts. A low price doesn't always mean you're getting a quality bargain. It would help if you considered cost and value when focusing on getting the most for your money in stock investing. A bargain stock may appear too good to be true, but that could also be because it is. You can look at the value of a company in many ways, but the first thing to consider is the price-to-earnings ratio, PE ratios. This ratio connects the price of the company's stock to the company's net profits quoted on a per-share basis. When the economy is in tatters and stock prices are down, PE ratios of 10 or lower are better. Number 5, dividends are growing. Long-term investing is where the actual payoff is for today's investors. But before you start staring at your calendar and dreaming of future profits, look at the company's current dividend picture. Reviewing 3 years of a company's sales gives an excellent overall gauge of its success. Conclusion: no one can earn their way to financial independence. The only way to attain financial freedom is by investing. What you invest, you hope to gain back in larger amounts. Informed decision-making is therefore key. If you do not want to work for the rest of your life, you must make it a goal to set some of the money you make aside for investment. By putting a fraction of your income into valuable assets, you are essentially making your money work hard for you so that it can yield good returns in the long run. One of the best and most profitable ways to make your money work for you today is investing in stocks. And like any meaningful pursuit in life, successful stock investing requires patience, diligence, knowledge, and insights into how financial markets operate. Admittedly, today's stock market is a little puzzling, especially for novice investors, but it can still be rewarding. With the help of this guide, you will be better informed than the average investor and make wise decisions regarding where to put your money. Remember, the purpose of this guide is not only to tell you about the basics of stock investing, but also to let you in on concrete strategies that can help you profit from the stock market. Before you invest, understand the fundamentals of stock investing. Then, put your money where it will count the most. Try this. Having the correct information is critical in your stock investing pursuits. You should collect as much data as you can on your stock picks twice, before you invest and after. Choose your broker carefully. One size does not fit all. Remember that diversification is vital if you want to make money.